Hindu Undivided Family Business. HUF is an entity formed automatically by members of the common ancestry including their wives and daughters. A HUF cannot be formed by a group of people who do not constitute a family. As such, a joint Hindu family in India is, in fact and by default, a HUF. A HUF enjoys a separate entity status under the Income Tax Act. The Income Tax Act considers HUF as a separate entity if the joint family wishes to register itself as such for reporting income. HUF, Partnership, LLP and Company. Generations of an HUF. In the paternal lineage, thus there is grandfather, father and grandchildren. These three successive generations of an undivided family are known as HUF. Secondly, though the word Hindu is conspicuous, the definition of HUF includes Buddhist, Jain and Sikh families as well. Partnership. Partnership implies contractual co-ownership of business. It is a relationship between two or more persons who agree to share the profits of a business. The business may be carried on by all or by some of the partners for and on behalf of all. The contract, an agreement enforceable at law, called deed, is the essence of a partnership. Limited liability partnership. Drawing on its name, LLP form of business organization is the one where the liability of the partners is limited. However, there is much more to this form. It has to be mandatorily incorporated or registered under the Limited Liability Partnership Act 2009. Company. Company form of business organization is the AG bearer of corporate businesses. Company indeed is a body corporate, having an existence independent of all its members. There is a requirement of the statutory audit of the accounts of a company and publication of its quarterly results to keep the investors well informed. Features of HUF business. Formed by birth in a Hindu family, members may naturally join each other in business. In contrast, in a Muslim family, if the siblings wish to associate in a business, they will have to do it contractually, example partnership agreement. Family pool of resources. It is possible to start or expand a large business. Moreover, the common pool of capital may be utilized to diversify business in sync with the aspirations of the members of the successive generations of the family. Social capital through family involvement. There is an instant trust among the family members as compared with the situation of partnership with strangers. Family members toil hard to build the family business. Moreover, they may specialize in different business functions for greater complementarity of the mutual skills. The family members are the automatic co-owners. Ownership in family business is an ascribed rather than earned status. It can actually be quite frustrating for the outsiders, example hired managers who help build the business. Features of HUF business. Decision-making is quick. In the absence of other active major members of the family, the head of the family known as Karta takes all the decisions. Subsequently, decisions are taken by and in the family. Prevalence of mutual trust, informality of communication makes decision-making quick. Unlimited liability of the Karta. It is a common limitation of proprietary forms of business organizations. In the event of insolvency, that is, liabilities is greater than assets, the owners, here the Karta, personal assets are invoked to make up the deficit. However, the liability of the other family members is limited to the extent of their share in the co-personery. Fate as a going concern. Few family businesses last beyond third generation. Often family feuds result in business splits. In India, the splits in the business houses of Birla, Modi, Goenkas and more recently the split in the second generation of Ambanis are instances to this effect. Succession of ownership. By will or application of the law of inheritance. A will or testament is a legal document by which a person to manage the estate until its final distribution. If the will is non-existent, the applicable law of inheritance will come into force. Features of partnership. Agreement. The agreement makes possible co-ownership of business by persons who do not share a common ancestry of a family. Two or more persons. Partnership allows raising of funds beyond the resources of an individual or sole proprietor. In fact, even a company, being an artificial person, can be admitted as a partner. There is a capacity on the maximum number of persons. It is 10 for a banking firm and 20 for other firms. Profit sharing. For there is risk sharing too. However, whilst profit sharing is an essential feature of partnership, loss sharing is not. Certain partners may be admitted only in the profits of the firm, example minor partners. Business object quite wide. A partnership cannot be formed for non-business purpose. However, the word business here includes every trade, occupation and profession. For example, many accounting, auditing and legal firms are organized as partnership RMS. Features of partnership. Mutual agency. Mutual agency is one for each other and for all, ensures that all the partners work in the common interest and in the interest of the firm. A partner's misdeeds impact all the partners and the fate of the firm. Unlimited liability. It is a common limitation of proprietary forms of business organizations. In the event of insolvency, that is, liabilities is greater than assets, the partner's personal assets are invoked to make up the deficit. Owing to the mutual agency, the liability of all the partners is both joint and several. Fate as a going concern. Since partnership arises out of contract, it also ceases in the same way. A partner may serve a notice of severance to the firm and the partnership comes to an end. The remaining partners may agree to carry on the business of the firm. Succession of ownership. Ownership is not easily transferable. A new partner can be admitted only if other partners consent. LLP an overview. Limited liability. No personal liability of partner, except in case of fraud. This does away with a major limitation of traditional partnership. Incorporation is mandatory. The mandatory registration brings the firm under the regulatory purview of the Ministry of Corporate Affairs. This increases its credibility. Separate legal entity. It is a legal entity separate from its partners. This does away with the uncertainty of the RM's existence as a going concern. Number of partners. In LLP, minimum 2 and no limit on maximum number of partners. The upper limit in the traditional partnership restricted the scope of business and future expansion plans. LLP an overview. Administrating authority. Registrar of Companies is the administrating authority. There is a body to control that brings credibility in the eyes of stakeholders. Statutory compliances. Designated partners to ensure the compliances. However, in comparison with the companies, the compliances are fewer and simpler. Agent. Every partner of LLP is only agent of firm. Absence of mutual agency enhances freedom at one hand, and, on the other hand, frees the other partners of the burden of responsibility of the acts of a partner. Features of private company. Constituting committees. Private companies are exempted from constituting such committees of the Board of Directors as Audit Committee, CSR Committee, Stakeholder Committee and the Nomination and Remuneration Committee. Number of members. In case of private company, minimum number of members is 02 and maximum number of members is 200. In case of public company, minimum number of members is 07 and there is no limit or maximum number of members. Transfer of shares. In a private company, there are restrictions on transfer of shares, whereas the shares may be freely tradable on stock exchange via listing in public companies.